Imagine this. 1 week, everything's normal. Your bank card works, your family's retirement savings looks solid, the world economy is just chugging along. The next week, the entire system freezes. Banks that have been around for over a century are just gone, overnight. Global trade is grinding to a halt, trillions of dollars of wealth have just vanished. And this isn't some Hollywood disaster movie. This was the reality in 2008. So the big question, the one we're still wrestling with, is this. How could a problem in the American housing market bring the entire global economy to its knees? Okay, let's get in.
It all kicked off with a promise. A simple, powerful idea plastered on billboards and pushed by loan officers across America. This one phrase, why rent when you can own? Well, it became the central lie that fueled a global catastrophe.
Wait, it's just hard to wrap my head around that. You're saying this entire massive global collapse started with a simple, almost positive-sounding slogan? There has to be more to the story.
You are absolutely right, Alex. That idea was just the spark. To really get what happened, we need to break it down. First, what actually built this massive housing bubble? Second, how on earth did risky mortgages from places like Florida and California turn into toxic bombs that blew up banks in Germany and Japan? Third, why did these giants, these titans like Lehman Brothers and AIG actually fail? And finally, what did the government do to stop the bleeding, and are we really any safer today? So let's start with the fuel for the fire, a housing gold rush built on a mountain of incredibly easy money. So after the dot-com bubble burst and the 9/11 attacks, the U.S. Federal Reserve did what central banks do when they're scared. They slashed interest rates, making them historically low. The idea was to make it super cheap to borrow money, to get people and companies spending again.
And all that cheap money just poured into the housing market, right? It sure did.
You combine that with what future Fed Chair Ben Bernanke called a global savings glut, basically a giant wave of cash coming from countries like China, all looking for a safe place to invest with a decent return, and you get a perfect storm. U.S. real estate, all packaged up, looked like the safest, most profitable bet on the planet. And all of this was propped up by a myth, a belief that became an article of faith. Housing prices will always go up. A house wasn't just a place to live anymore. It was like a lottery ticket you could flip for a massive profit.
But Professor, for a housing boom that big, people have to actually get loans. How could so many people afford to buy homes, especially if they were just flipping them?
That's the billion-dollar question, isn't it? The truth is, they couldn't afford it. Not by any normal, sane lending standard. But the standards were just thrown out the window. Lenders started pushing what we call subprime mortgages, and the most notorious of them all were the ninja loans. It's an acronym, and it's as crazy as it sounds. No income, no job, and no assets. You could get a loan for hundreds of thousands of dollars without proving you had any way to pay it back.
Wow. Okay, so that's a perfect textbook example of a moral hazard and a principal agent problem, right? The mortgage brokers got their commission for signing up the loan, so they had absolutely no reason to care if the borrower could repay it because they just sold that loan to somebody else right away.
You hit the nail on the head. The risk was just passed up the chain, and every single link in that chain got paid to look the other way.
So, while regular folks on Main Street were caught up in this frenzy of buying houses they couldn't afford, Wall Street was busy with something else. They were performing what you can only really call a dangerous kind of financial alchemy. They took these incredibly risky loans, these ninja loans, and claimed they could spin them into solid gold.
Now, this magic trick had a name: securitization. Here's how it worked. Investment banks would buy up thousands of these terrible subprime loans and bundle them all together into these really complex financial products called mortgage-backed securities, or MBS, and collateralized debt obligations, or CDOs. Now here's the clever part. They sliced these big bundles into different pieces, called tranches. The top tranches were supposed to be paid first from the mortgage payments coming in, so they were seen as super safe. The bottom tranches would take the first loss if people started defaulting, so they were really risky. The whole theory was that by mixing so many loans together, the risk was diversified away, making those top slices practically risk-free.
Hold on. So they took thousands of really bad, high-risk loans, mashed them all together, cut them up into pieces, and just declared the top piece safe? That sounds incredibly fragile. How did they convince sophisticated investors this was a good idea?
Well, they got the official referees of the financial world to give it their highest stamp of approval. The big credit rating agencies, Moody's, S&P, Fitch, were supposed to be the independent watchdogs. But here's the fatal flaw, the massive conflict of interest. The banks paid them millions of dollars to rate these products. So if one agency got tough and refused to give a good rating, the bank would just walk down the street to their competitor. So what happened?
They slapped AAA ratings, the exact same rating given to super safe U.S. government debt, on these bundles of junk mortgages. One source we looked at used a phrase that is just chillingly perfect. They called it financial plutonium. Think about that. They weren't just mislabeling a risky investment. They were taking something fundamentally radioactive, something with the power to cause a complete meltdown of the entire system, and they were selling it as a clean, safe energy source to pension funds, to towns and cities, to investors all over the world. And those investors, desperate for better returns in a world of low interest rates, they bought it all up.
Okay, so we've got this gigantic mountain of toxic assets that everyone thinks is safe. But I've also heard that insurance products were a huge part of the problem, especially when the insurance giant AIG collapsed. How did they fit into this picture? Great question. Because this is where the whole thing just goes from reckless to completely insane. Wall Street invented something called a credit default swap, a CDS. Now on paper, it's just an insurance policy on one of these mortgage-backed securities. But here's the wild part. You didn't actually have to own the security to buy the insurance on it. This turned the entire CDS market into a giant unregulated casino. It was literally like buying fire insurance on your neighbor's house. All of a sudden, you have a financial incentive for their house to burn down. And because firms like AIG weren't regulated like traditional insurance companies, they sold hundreds of billions of dollars of this insurance without having the money to actually pay up if things went bad.
So let's recap where we are. We have a system built entirely on a lie. It's constructed with financial plutonium, and it's leveraged to the absolute hilt with these casino-style side bets. It was a giant wobbling Jenga tower. And in 2006, somebody finally pulled the wrong block.
And you know, the trigger itself was so simple. U.S. housing prices stopped going up. That's it. The entire model was based on the idea that you could always sell your house for more than you owed on it. The moment prices started to fall, millions of people with these subprime loans were suddenly underwater. They owed more than their house was worth. So defaults just exploded. And those safe AAA-rated securities, they were suddenly revealed to be completely worthless.
And this is the point where the run on the shadow banking system starts, isn't it? All those firms that funded their day-to-day operations with short-term loans, using these mortgage-backed securities as collateral, suddenly found their collateral was junk and nobody would lend to them.
Precisely. Bear Stearns had to be rescued in a fire sale in March of 2008. But the real earthquake, the moment the world changed, was September 15, 2008. That was the day the U.S. government decided to let Lehman Brothers fail.
And this was the moment of pure, absolute panic. Lehman was so deeply connected to every other bank, every other fund, every other company that its failure caused a complete cardiac arrest of the global financial system. Suddenly, nobody knew who was safe. Nobody knew who might collapse next. Banks just stopped lending to each other completely. Credit, the lifeblood of the economy, froze solid. One source called it a stage 4 fraud cancer that was now spreading through the entire market. The power cord to the global economy had been ripped out of the wall.
So the system is in total freefall. A complete meltdown seems like it's just hours away. What on earth did the government and the Federal Reserve do to stop the bleeding? It must have been a completely unprecedented response.
Oh, it was. With the global economy staring into the abyss, policymakers basically unleashed every weapon they had in their arsenal. And then they had to invent a few new ones on the spot.
The first really big move was the Troubled Asset Relief Program, or TARP. This was a $700 billion bailout fund. Now, the original plan was to use this money to buy up all those toxic assets from the banks. But things were moving so fast and the panic was so severe that they switched gears and started injecting capital directly into the banks, basically forcing them to take taxpayer money to keep them from collapsing one after the other, like dominoes. As you can imagine, it was hugely controversial. A lot of people saw it as a bailout for the very people who caused the mess. But at the time, policymakers felt they had no choice but to cushion the fall.
But even TARP wasn't enough to get credit flowing again. The Fed had already cut interest rates to zero, so their main tool was useless. That's when they brought out the heavy artillery, a policy called quantitative easing, or QE. Now, this was different from TARP. This wasn't Congress spending taxpayer money. This was the Fed itself creating trillions of dollars out of thin air, electronically, and using that new money to buy government bonds and those toxic mortgage-backed securities from the financial system. The goal was to flood the system with cash, push down long-term interest rates, and try to kickstart lending again. They quickly earned a nickname, the money cannon. So between the bailouts and the money cannon, the government and the Fed did manage to stabilize the financial system. They prevented a full-blown second Great Depression. But this intervention came at a staggering price, and the bill for all of it was sent directly to Main Street. The fallout for ordinary people was just devastating. As the economy plunged into what we now call the Great Recession, 8 million Americans lost their jobs.
4 million families who had been sold mortgages they could never afford on homes that were now worth less than their loans lost those homes to foreclosure. And an almost unbelievable $19 trillion in household wealth, in retirement accounts, in home equity, basically the life savings of an entire generation. It just evaporated. The human cost was absolutely immense.
And this is what made people so incredibly angry, right? The feeling that the exact same people who had caused the crisis got bailed out, while millions of regular people were just left to suffer the consequences.
Exactly that. The contract was just jarring. You had the architects of this whole mess walking away with multi-million-dollar bonuses and golden parachutes, while millions of families were dealing with pink slips and foreclosure notices. That deep sense of injustice fueled political movements on both the left and the right, from Occupy Wall Street to the Tea Party, and you can still feel that anger in our politics today.
And you know, it's fascinating. The rebellion wasn't just political, it was technological too. In October 2008, right at the absolute peak of the panic, the white paper for Bitcoin was quietly published by the anonymous creator Satoshi Nakamoto. And it was a direct answer to the crisis. It proposed a totally new, decentralized financial system. One with no central banks to print money, no big banks to bail out. It was born from this profound sense of betrayal and distrust in the very institutions that had just failed the world so spectacularly.
So, let's just quickly trace the whole story. It starts with cheap money and a crazy belief that house prices could never fall. That led to reckless lending. Wall Street then bundled up all that risk, disguised it as safe, and sold it to the world. When the housing market finally cracked, the whole Jenga tower came crashing down, freezing the entire global financial system. The government then stepped in with massive, controversial bailouts and money printing, which stopped a total depression but left behind this legacy of debt and public anger. We did get new regulations like the Dodd-Frank Act, but the biggest question is still out there. Have we really solved the problem of banks being too big to fail? The 2008 crisis was built on the simple lie that housing prices only go up. It's a powerful reminder that huge, complex systems can be brought down by a single, flawed idea that everyone just accepts as truth. So the question we have to leave you with is this: what is the simple, unquestioned lie we all believe today that might just be the foundation of the next crisis?